Welcome to TheoTRADE. This is Don Kaufman. It's January 19th, 2024. We are just seconds after the cash close here on this Friday afternoon. The markets just rip with a fever pitch to the upside. People, it has been a long time since we've seen this kind of market turn around. Let's explain some of the driving forces kind of behind this and some of the areas to be, aware of right now. All right, let's break it down here, of course, in this TheoTRADE's weekend update. First and foremost, I want to take a look at expected move. So for those of you that maybe are a little newer, are not necessarily introduced to expected move, let's go right to it here. This is the SPX, better known as the mother of all products. What we do on a week-to-week basis is we look at how the options marketplace is handicapping forward risk. In this particular instance, and I'm going to show you exactly where it comes from here momentarily, but in this particular instance, if you take a look at these three lines drawn on your screen, in fact, you know what? I'm going to do a better job of that. I'm going to zoom into this, into some highly detailed trade over here, but because it's that critical. This central line on your screen, that's where the week started, right? The upper line is an upper edge of an expected move. The lower line is the lower edge of the expected move. The expected move, of the week that we just passed through was roughly plus or minus $55 in change. And of course, I'm going to show you again momentarily where that $55 comes from. But one of the most astounding aspects, even in the midst of what I kind of term, it's just a fever pitch to the upside, we adhered perfectly to both the upper and lower edges of expected move throughout the course of the week, which to me is just downright astounding. In a marketplace, again, that feels like it's got this fever pitch, but it is somewhat efficient in that. Now, let's actually show you and break this down. First of all, here we're going to a 1 day, 1 minute. Why? Just to show you. Here again is that kind of central line. That's where the week started. Where did we end specifically today? On it. That literally is the upper edge of the expected move. And if you have any question, if that has viability, you need only look back. Let's now open this up to the last 4 days, a 4-day trading week, and we're going to put this into 10 minutes for 4 days. And I want you to see we were adhering to the lower edge of the expected move. Of course, earlier in the week, bounced around it. We ripped literally today right to the upper edge of the expected move. Now, excuse me, where are we deriving that expected move from? Well, as it pertains to SPX, one of the first things I'm always going to say, you need to use the SPX, to source expected move, not the ES, not the spiders. The SPX is the mother of all products. Why do I call it that? Because look at the order flow in here. So about 4.3 million contracts traded today. Like, oh, whatever, man, 4.3 million contracts. Look, the spiders, take a look at the spiders with me. They did what? 10.5 million. So why don't we look at the spiders? Because the SPX is 10 times the size. I mean, if you put another zero at the end of this, it's like the equivalency in spider terms. It'd be like the equivalency of 40 some odd million contracts trading. What I'm saying is that the notional value equivalency, makes the SPX massive. Notional value basically being the dollar equivalency. Like you can't compare SPX to spiders without again, adding a zero to it. So the mother of all products here designates it's the one you got to look at. So with the SPX, what we do is we look at the SPX and we wait until exactly 15 minutes after the cash close. We're still 5 minutes away from that right now. And you look precisely 7 days out. So in this particular instance, here we are, we're exactly 7 days out. This is next Friday's expiration. Right now, we're hovering around about a $58 expected move. So the expected move, yeah, it's an equation, but it's an equation but it's an averaging formula. It's derived directly from averaging the prices of options within a given chain. So what is better at handicapping forward risk than a market on forward risk? Meaning that, use a lot of different technicals and a MACD and Fibonacci and a Bollinger Band trying to discern where the market's going to go. I'm telling you, the option market is handicapping where it's going to go. Okay, look how much like volume and open interest trades in this thing. Right, this is next Friday's expiration. Okay, there's tens of billions of dollars that are being traded, saying like, hey, look, this past week we're supposed to move 55 bucks. What did we do? We moved $55. Okay, on the button. You just can't make that up. That little dashed line over there is effectively where we closed. Right there is the expected move. You're within pennies. And you do realize that you're trading a $4,800 product. And it misses a line that we drew a week ago by pennies. The reason I'm spending so much time on this, it is astounding. It is one of the most underutilized resources to you. Use this. Use it to manage risk. Okay, use it to lay butterflies around. Use it because, again, it is handicapping forward risk in a spectacular fashion. All right, we'll come back to expected move towards the end of this when markets kind of settle in, about 15 minutes after the close. Now, let's get down to it. So, as I said, markets, they ripped to the upside. Fever pitch. Tech came roaring back. When tech came roaring back, initially, people are pointing towards Apple. No question. No question, Apple had a lot to do with this. Apple actually received an upgrade. Apple has the new headset coming out. Apple. Nevertheless, on a year-to-date percentage, and I'm looking, yeah, I know it's the beginning of the year, but on a year-to-date percentage, Apple's only up 3%. I don't want to hear it. It's all right now Nvidia. It's all Nvidia. And you can look at Meta. Okay, Meta's also been involved. In fact, it's news from Meta today, okay, that drove Nvidia dramatically higher. Nvidia, though, has been on a tear. It's literally up 23%. And if you take a look at its market cap, you got to think about like the damage this is inflicting, if you will, to the upside. And most people don't think of like damage to the upside out of nowhere now. This is a $1.5 trillion company. But, okay, you're missing something. If you just look at the market cap, oh, yeah, it's 1.5 trillion. That's nothing, Don, compared to Apple, because where's Apple? Okay, where's Microsoft? Both Apple and Microsoft are $3 trillion companies. Yes, but you're missing something. What are you missing? Okay, you're not volatility adjusting. So if you look at Apple, it's got about a 20 vol. Okay, and that's assuming there's no earnings coming out. When it gets to earnings, it jumps up to like a 30 vol, right? But that's Apple, about a 20 vol. Okay, you want to talk about Microsoft? Microsoft over there, oh, hurt me. It's like an 18 vol. You want to go into Nvidia? Okay, where's Nvidia? Yeah, it's almost a 40 vol. So you're basically dealing with double the price action in there, which, guess what? Lo and behold, Nvidia then acts exactly like a $3 trillion market cap. People, it is the market right now. Nvidia is the market, and I can't stress that enough. Now, my next bullet point over here is, I'm like, oh, tech's roaring back. Yeah, tech came roaring back, but everything pales in comparison to what's going on in Nvidia. Nvidia, its call buyers have gone wild. One of the things that's apparent and very transparent, if you know where to look, is that Nvidia is seeing massive amounts of call buying. I've explained this as well, and it's important to kind of have some background knowledge of like options, obviously, when tuning into this. But when you look at a marketplace, if you look at a marketplace, and a marketplace is like, let's be $4.10, okay, at, for instance, 420. So that's a market, let's say, in an option. What's going on in Nvidia is people, okay, are going in there and they're just sweeping the market at 420. And when I say people, I'm not talking about mom and pop sitting at home trading through thinkorswim or trading through Tasty. You're getting proprietary trading firms, hedge funds. They're coming in and rushing the marketplace, okay, and just literally buying calls in mass quantity at the marketplace. And you go, how can you possibly see that? You only need to look at trade at the ask or above. If you look at traded at the ask or above, again, that market of 410, okay, at 420, traded at the ask or above would indicate they came in at 420. Well, look at the number that have traded there. Now, yes, some of them were sold then later on in the day. By the way, trading firms, if you know what you're doing, you don't have to sell the option to be able to get out of it, especially if it goes in the money. The option goes in the money, okay? You just basically go like, well, what we call it like short against the box or conversion, reversals, for those of you that know what I'm talking about. For the most part, what basically happens is you buy a call, it goes in the money, okay? You can actually short some shares against that, neutralize the position, and yeah, it can expire in the money, shares get called away, yada, yada, yada. It's not a big issue. And it, again, depends whether, you're buying calls, buying puts, but buying calls, okay, and then actually relinquishing that position by using shares against it is something that's very common done. So you don't necessarily have to unwind the position in the traditional means that most retail traders would think. Okay. Again, I think that the term short against the box, okay, where you're basically both long and short, suffice to say would kind of clarify that to some degree for some of you. Anyway, with that being said, the reason I'm spending so much time in Nvidia, because it is the stock that has moved the market. And yes, we could talk about other sectors and so forth. When you start looking at other sectors, and I just want to bring this up, you look at other sectors, and I'm bringing up energy right now. Energy's down 5% on a year-to-date basis. Okay, let's bring up the financials, because the financials, they ripped today, and I was surprised about that. Yeah, they're flat on the year. What else you got? Oh, let's go over to utility sector. The utility sector is down 5%. Like, the point that I'm trying to make, it's a really simple one. Okay, you can say whatever you want about the marketplace, but the market right now, it is, once again, it's not just the big tech stocks. No, it's Nvidia. It's Nvidia. Oh, it's Apple. Apple, again, it's only up 3% on a year-to-date basis. Okay, 2 days ago, Apple was down on the year. So yes, Apple helped fuel things. It definitely helped fuel things. There's no question. Again, Meta is helping fuel things. But everything falls by the wayside till you see Nvidia, which is up 23%. By the way, if you're curious about Tesla, it's actually down 15%. It's crazy because you're literally looking at this, and I know Microsoft's up as well, but you're looking at this and you're like, and then there was what? One, maybe two stocks? And that's, okay, that is a cause for concern. And that's why I call this markets rip with a fever pitch, because it's feverish. You're like, oh, you kind of feel like people, I don't want to miss out on this one. Okay. I'll tell you what, there's rallies like this that I absolutely want to miss out on. I want no part of it. I'm going to show you exactly why. So again, call buyers are going wild inside of Nvidia. And what that is sparking is this constant feedback loop. Okay. You buy calls, the market makers sell you the calls, the market makers go buy stock. When they buy stock, it drives stock up. Remember, everything you do on the professional side is about going, okay, to a neutral stance. So a trader goes out, and I always try to script this for people, no matter how many times I do it. Some people still, get a little bit, lost in the weeds, and it's okay, right? So, and I'm going to use you as an example. So if you go out again and you buy calls, okay, you're buying calls. Doesn't matter how many calls you buy, but whatever you're doing, you're creating what we term positive delta. And if you buy at the money calls and you bought a 10 lot, okay, that is 500 positive deltas. The market maker right here, MM, the market maker is going to sell you those calls. And they love to sell you the calls. Why? Because you just bought them at the market. So they'll sell you the calls. But when they sell you the calls, it produces for them negative 500 deltas. So how do they actually neutralize negative 500 deltas? By going out and buying 500 shares of stock. So they neutralize it. Then somebody else goes out and buy calls, and it forces this market maker to actually buy more stock and buy more stock and buy more stock. And you go, well, isn't the market maker though stuck with a bunch of short calls? And then if the market maker stuck with calls and all that stock, okay, no, because this neutralizes itself out. And if they're in zero DTE, okay, basically the stock can get called away. That's a little bit of a better explanation, I think. But you're seeing this now on a grandiose and a professional level. It's not just mom and pop that are out there buying calls. Like, look at the number of options that have traded in here today. It's sick. Absolutely sick. Look at this, 118,000, okay, on the call side. It's insane. That is the volume. The open interest, okay, which is calculated at the end of the day, was only like 9,000 yesterday. 118,000 traded those today. So there's no if and or but about it. There's no argument about what's going on in here. But here's the really crazy stuff. Crazy stuff is why I'm calling this a fever pitch. Are you aware that the volatility is starting to heavily invert? What that basically implies is that there's such a fever pitch inside of Nvidia that the calls and the premium of the calls is going up. And in many cases, the premium of the call is exceeding its equidistant put. You're like, what? Okay, where's the market trading in here? The market trading here in Nvidia, okay, is what? Basically 595, 595, 595. Here, I'm going to highlight a couple of things over here. Really try to clean this up because I think that this stuff is incredibly, incredibly important, especially if you're going to be trading these markets right now. So there we are at 595. Excuse me. Let's go about what? Let's go an even, $30, $40 out of the money. You want to go even further? Let's get crazy. Okay, we'll come all the way down here to the 550s, which is what? Approximately $45 out of the money. We'll do the exact same thing, okay, on the call side. What you are looking at right now is the implied volatilities are almost the same. The calls, though, are absolutely trading for more, okay, more than the puts. Now, granted, there's a little bit of cost to carry in there, but as I start to go even further out of the money, the skew, okay, picks up in the calls, which again is indicative very much so of a fever pitch inside of a product. Now, yes, I'm selecting options that are 28 days out. Some of this is even significantly more pronounced in the near term stuff, with like out of the money options getting all the way to like, 39 vols. People, you just can't make this crap up. If I look at the 7-day options, look at the 640s. These 640s over here, like, good, I get it, man. They're, 40, 50 bucks out of the money. And we can look at the put side of things. The calls, okay, are trading for quite a bit more than puts are in some cases in terms of implied volatility. So yeah, you got some issues there in Nvidia. The question of that is always like, how long is it going to last? Look, when things are fever pitch, okay, that unto itself is implying something. And I am trying to imply something. This is a marketplace you better be careful in right now, okay? Because when things go parabolic, they may not end well. Now, we have seen Nvidia go parabolic in the past, right? And it can last a long time, but nothing is as astounding as the present move. Here's a move right here from 200 straight shot to 350. This, though, it's basically a vertical move higher, all right? So at some point, without unequivocation, Nvidia has a very violent pullback. Trying to handicap when that's going to come, that's when we'll go to auto expected moves. When you go to auto expected moves, start to see that's almost a 3 standard deviation, another 2 deviation move. Right there, okay, we are statistically cooked to the upside inside of Nvidia. This is something, if it continues to break to the upside on Monday, we may actually engage in a bit of a bearish in-out spread in Nvidia in the near term. All right, switching gears entirely. So we talked about Nvidia because, lo and behold, Nvidia is the marketplace. But there's another really critical aspect to this market, and suffice to say that I'm not just surprised by this, I'm kind of shocked. And that's this. If you look at the FedWatch tool here, Chicago Mercantile Exchange puts out this FedWatch tool. The Fed Fund Futures, for those of you that don't know what this is a tradable, tangible marketplace. This is a market, again, you can trade it, right? It's not exactly exciting to trade, but if you look at the January 31st meeting, and I'm switching back and forth here, but if you look at the January 31st meeting, it basically says, okay, at the end of this month, in January, there's a 7% chance that the Fed leaves rates alone. Now, I've been talking about this a lot, but if you go to the March meeting, March meeting now, is it's even money. Basically, it's a 50-50. That is the most dramatic move that we've seen in a very long time, meaning that the Fed, now is not per se, it's a coin flip whether they're going to cut rates or not. The market is all of a sudden in ebbing and flowing back to saying, no, 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 no. We're not going to cut rates. We are not going to cut rates. And I think that the most shocking thing, because those of you that had actually tuned into the previous week's videos, I talked about this extensively. And I said, if the market doesn't get what the market wants, the market's going to panic, possibly throw a little hissy fit. But you know what? It hasn't happened. Fed funds went back to 50-50 in March. Look where the market is. I mean, look, we're sitting at the upper edge of the expected move. It made sense earlier in the week. Earlier in the week, we're at the lower edge of the expected move. Like we're ready to break through the lower edge of the expected move on Tuesday. You need only look at the chart, right? You're at the lower edge of the expected move. We're going to break through. Things were, tentative at best on Tuesday. Here we are on Friday, okay? Pop to the upside. Okay, pop to the upside over here, and it's phenomenal. By the way, I do apologize. This is actually Wednesday. It's a 4-day trading week. It's very confusing. This is Tuesday. This is Wednesday. This is Thursday. This is Friday. Okay, now I'll get that right. But again, you're not even halfway through the week. We're about to break through the downside. All of a sudden, pop. We're right back over here. And at the same time that happened, okay, the chances of a rate cut have diminished to 50-50. And I think a lot of people are going to miss that. So you got markets ripping with this fever pitch, and there's nothing else to say but that. You look at every technical out there. What are you going to say? There's nothing you can say. The Nasdaq's at new highs. Okay. The bonds, what do the bonds do? The bonds have been selling off now the last couple of weeks. That is not a bullish indication for markets. We shrugged everything off. Why? Because Nvidia will save us all. Well, that's what we're going to be seeing this next week. I think that this might be a viable position again if we continue to rip to the upside on Monday. All right, let's cruise back over to the SPX. Look, kind of settled in. This past week, we had a $55 expected move. We already said, look, we hit the lower edge of the expected move. We hit the upper edge of the expected move. We landed, okay, on the upper edge of the expected move. But more importantly and more appropriately, where are we headed next week? It's approximately $58.27. $58.27. So there is a little bit, okay, extra movement packed in, right? Wrong. It's actually a 5-day trading week. So for the most part, we just came out of a week, okay, 4-day trading week, where volatility was relatively wild. Okay, you can't discount that. There's a lot of two-sided trade in here. Okay, big move to the upside specifically today. Big moves to the downside earlier in the week. But after all of that, we're still only anticipating approximately a $58 move. I suggest hands and feet inside of the vehicle next week is not going to be quiet. I mean, the last thing that I would leave you with on this weekend's update, there's no question that we have traded to the upside. Okay, but there's also absolutely no question, okay, we are now open to two-sided trade. We are seeing, okay, markets both higher and lower. And I'll tell you what, I will take that all day long. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.